Hello, my name is Jeffrey Smith. I'm the Chief Instructor at DTI. I want to go through option terminology. Of course, there is risk in trading. Past performance is not indicative of future results. And simple rule, if you can't afford the loss, don't take the trade. I'm going to go through what strike price is, at the money, in the money, out of the money, and a little bit about leaps. Strike price is the price at which the option can be exercised, whether it's a call or a put, and in fact every option will have a strike price, the price at which you can buy or the price at which you can sell. Every call or option will have this strike price, and of course if you're looking at an option and you're looking at a December 3/15 Apple call, the strike price is $315. At the money, and some people will say ATM, kind of like automatic teller machine, but is basically at the strike price. It's when the strike price of the option and the current price of the underlying security are basically at the same price. That is an at the money call or an at the money put. So if you're looking at a stock, let's just say Coca-Cola, and it's at $40, and you want to buy a Coca-Cola $40 call, that is an at-the-money call. Another example here, if Apple's trading at $314.95 and you purchase a December 3/15 put, it's basically an at-the-money put. In the money, we're going to have to kind of differentiate between calls and puts now, because depending on which direction the market's moving, whether a call option will be in the money or a put option will be in the money. It's when the price of the underlying security is higher than the strike price on a call option. And of course, it's when the price of the underlying security is lower than the strike price of a put option. So very quickly, using our little Apple example there, if Apple's trading at $310 per share and you purchase a December 3/15 put, now look at the current price of Apple is trading at $310. The strike price of the put is at $315. Now remember, a put, the market has to go below that strike price to be in the money. And of course, if on a put you have the right to sell, and therefore if the market goes lower, then you'll make money on the stock or even on the option. So if we're purchasing a 3/15 put, it's actually in the money by $5 because the current price is $5 below the strike price of the option. And of course, if we exercised it immediately, we'd make $5 a share. So this is an in the money put. Out of the money, again differentiating between calls and puts here, it's when the price of the underlying security is below the strike price on a call option. That means it hasn't made it up to strike yet. And of course, when the price of the underlying security is higher than the strike price of the put option. That means it hasn't made it down to the strike price yet. So if we exercised it, we would immediately lose money, right? So if Apple's trading at $309 and you purchase a $315 call, that's considered an out of the money call. You have $6 to get up to strike on the call option. So the only value that's in here is extrinsic value, time value. We have no intrinsic value until we get above $315, which is the strike on this option. That's considered out of the money. Finally, leaps are long-term options. They usually expire in January, and they go out up to about 4 years. In other words, if you are trading currently in November of 2013, and you think that IBM's going to get up to $250 per share by the end of 2014, you can go out and buy the January 2015 year, the $250 call, and that gives you a little over a year to hold on to that call option. It will cost more money because of the time value, but if you think about buying 100 shares of IBM, which would cost you somewhere around $20,000, you could probably buy the call option for about $1,000, and you can control 100 shares of IBM for a whole year. They're just very, very long-term options to take advantage of longer term moves in a stock. That's the end of this video. Thank you very much.